Chapter. We're talking real money.
Thanks for being part of Talking Real Money here every single day, trying to help you understand how money works, be a better investor, kind of dealing with money so it doesn't deal with you. I think that's how I'd put it. So I'm Tom Cock. We have a special guest. Well, not really a guest, but kind of co-host coming up in just a couple minutes to take some of your questions. And of course, we love to get more of them. So anytime, go to talkingrealmoney.com, click on contact us, send in those questions. We're happy to answer them. We've got some great ones coming up. But before we do that, you know, one of the things that troubles us deeply here are the scare headlines, the news cycles, which generally, and we've seen a bit of this spring, trigger people to sell their investments and then to say, well, I'll wait until X to do Y, or, you know, hang out and see what's going to happen. And that is not a good long-term strategy. In fact, that's not a strategy at all. That's simply a market timing move that we can show you over history has meant you have less money. It also creates all these headlines and scare things, panic in some way. So recently, the Dow Jones Industrial Average was down 1,051 points in a week. And that gave people the headline that they wanted. The Dow is down more than 1,000 points. This from Jason Zweig, and he says, especially if you're a younger or less experienced investor, a concept you need to understand is denominator blindness. That's the automatic human tendency to fixate on the top of the fraction, not the bottom. We're wired to pay attention to changes than to levels. The magnitude of negative change is almost impossible to ignore, whereas the total number on which those changes is based is less vivid and harder to hold in your memory for reference. Let me give you an example. I think this is fantastic. So in this case, the Dow fell 1,051 points. You know we don't pay attention to the Dow anyway, but this makes a great example. The denominator, however, the below the line is 42,654. So, okay, that's a drop of 2.4%. That's still not a small number. I get it. But when you go back in history and look at 1,000 points, it really means something. Let me give you an example that Jason uses in terms of temperature, because it's something us in Seattle, we know about 50 degrees because it's about 50 degrees 2/3 of the year here, although we're finally moving into some nice weather now. I guess I shouldn't complain. But imagine a day where the temperature is 50 degrees Fahrenheit. 50 degrees Fahrenheit, okay? It drops to 48.8 degrees. Would you notice? Would you care? Would you run out and throw 3 more sweaters on? Would you buy a down coat? The 50 to 48.8 is the equivalent of a 2.4% decline. That's it. It's nothing major. It's nothing to get worked up about. So please don't market time. Don't sell your stocks. Don't think you're going to see the future enough to do something different. Just buy and hold, have the right portfolio for your risk tolerance, and leave it at that. All right. Enough of my silliness to start all this, because we've got somebody very serious in the studio today. Glad she's back. Roxy Butner, thank you for taking time out of your busy advising day to be part of Talking Real Money.
Thank you. So serious.
I know. Well, so it sounds
Not
anyway.
like your tie today.
Oh, thank you. Yes, the tie is a little wacky. We can't pick on it, though, because it's my dad's tie, so we have to be nice about these things. So, all right. So we get questions, and you want answers. So what do we got this week?
The first one is from Jeff in Orange, California. And he says, "Hi guys, prayers for Dawn's quick recovery. I've been a listener for several years now, also listened to Paul M., and have seen several retire meets online. My wife and I were both school teachers in California, retired in 2013. To avoid the hodgepodgery, we took our 403b accounts and put them in IRAs, split between Fidelity and Vanguard. All of our investments are in those accounts. Recently, my wife got some money from the sale of land held in a family partnership. It effectively doubled her money, but now I want to open a separate taxable brokerage account for her. Question is where to put what? I've heard equities in the taxable and bonds in the IRA. Is that correct? Should she have any of it the other way around? Keep it in the 2 custodians? ? The investments are simple: S&P 500 index funds and short-term bond funds. Thanks for the advice.
All right, Jeff, thank you for the question. And let's work backwards on this, first of all, because we're going to want you to own more than, when it comes to the stock side of all this, more than just the S&P 500. In fact, a lot more, because that's 500 stocks. We prefer to see you own somewhere around 10,000 companies. You got the big ones, the big, huge U.S. firms, the biggest, but you need the little ones, and you need the value stocks, the ones that made Warren Buffett a lot of money. Then you got to do the same thing overseas. You got to own large stocks there and small stocks and growth and value. Throw in some emerging markets. You really want to make it work, you could throw in some REITs as well. You got to own all parts of that market. So that's one. And frankly, pretty easy to do in today's world. You could do it very inexpensively using exchange-traded funds. Then to the fixed income part of your portfolio, which has been getting more attention lately in the news due to the trouble of the Treasury selling some of the bonds, et cetera, the longer-term ones especially. We want your maturities to be short and intermediate, because if you just hold short-term debt, you're not going to get the interest on all that, the payout, going to be pretty small. So we want you to think about doing both of those. And do you want to add a little bit to that before I move on to the second part of this?
In terms of the bonds there?
Yeah.
Yeah, I mean, and the other thing that I was going to touch on is what type of bonds, not just the duration, but also depending on your tax situation. Do you want municipal bonds or not? And if you don't need municipal bonds in the brokerage, you don't necessarily need to put municipal bonds in an IRA. But if you are putting them in the brokerage, you'd want to maybe consider that depending on your tax bracket.
I think that's exactly right. So back to, let's see, the second part of all this, 2 custodians. I would have 1 custodian.
There's no reason to have them at 2.
It's in today's world, you can pretty much buy any exchange-traded fund at any custodian. Now, for our clients, we use Charles Schwab. We like Schwab. They built a business of being a great custodian, I think better than anybody else. But, I'm an old guy. There's new stuff out in the world all the time. So, but you can trade these exchange-traded funds for nothing. Sometimes there's a bid-ask difference there, but you're a long-term investor. You don't care because you're not looking at trades every day. But yes, I would have a single custodian, and I would probably take the 403Bs and the IRAs and all that stuff and have for each person, and you can argue with me if I'm wrong here, I would have 1 IRA, right, especially after you're retired. I would have 1 Roth IRA for each person. Remember, those have to be, it's an individual account, so that's one person's account. And then a joint account or similar, but clean it all up, because it just, what we see is this hodgepodgery. People call us all the time. Just had a guy sending his stuff yesterday. He had 13 accounts. I mean, it's, how do you keep track of all that stuff? So go ahead.
Yeah, especially if you're kind of managing it yourself, you want to have it all together. I can't tell from the question if he has any Roth balances. It might just be IRAs. So it would be, 2 IRAs, for example, at Fidelity, and 1 individual for your wife, or joint, depending on how you guys have your estate planning figured. But I think the big question here, too, is to start off with what is the right overall allocation of your stocks to bonds first. And then from there, you kind of have to do a little bit of piecing together to figure out, okay, we want 60% stocks, 40% bonds overall. What are our total balances in our pre-tax accounts? What's the balance in the taxable account? And say, can we go a little bit more aggressive in the taxable account, which is more tax favorable, as you know, because you're either taxed at 0% on earnings or 15%, sometimes 20%, but pretty rare.
Rarely.
And then you decide from there. I don't generally see most folks putting 100% bonds in IRAs. It makes sense to have sort of a reasonable split. Maybe you do 80-20 in the taxable account. Maybe you do 40-60 in the IRAs, and that gets you to a 60-40 overall. But it's important to pay attention to the overall picture and not just those new funds from the proceeds of that land.
Yeah, I mean, in a perfect world, yes. Stocks in the taxable, fixed income in the IRAs because of the treatment of the growth, the interest, et cetera. But very rarely does that work out. Here's the problem if you do that too, by the way. Your one account's going to go way up and the other one's going to sit there and you're going to go, why am I investing? What am I missing here? It's very hard for people to put that all together. You have somebody else manage it for you, it could be much easier. But yeah, I agree. You start with the overall. What's my stock to bond ratio? Then if I can jam as much as I can in the stocks in the taxable and less in the IRA, sure. But it does come down to that stock to bond ratio at the beginning, and that's something you need to know by planning, risk capacity, and all the rest of those things. And
also your distribution needs. So you have to consider those IRA balances. Are you drawing off of those now? And if not, what will your RMDs look like in the future? It kind of comes into, what is this money going to be for? Are you going to start drawing off that money now, or do you need it for long-term care costs, or is it really more of a legacy planning question? And then you want to consider what grows the most will be the most tax favorable for your beneficiaries. So there's a few different facets that you should come at this.
Yeah, I mean, here's the thing, and frankly, Jeff, to consider as well. This is not a sales pitch, But because this is such a point of inflection here, I mean, you're moving the money, you're getting things set up, at least consider having a professional look at it. And maybe even we do a free look, but maybe even pay somebody, because you're going to want that to make sure that everything you're doing makes sense. And then you say, well, I can self-manage it, et cetera. I even wonder about that a little bit, because your diversification is not what we would preach nor manage. So, but I would have a second set of eyes on that. Congratulations on the upcoming retirement. That's exciting too. We got more questions. By the way, you can send them to us. It's easy. You just go to talkingrealmoney.com and you click on contact us and you type it in. And if you want to record it, you can do that too. And Don takes the recorded ones because he's very special. And I'm not, I guess. So I'm over it though.
Okay, our next one is from Jason in Tigard, Oregon. Having struggles between risk tolerance and risk capacity. We're 55 and 56, expecting to retire in about 5 years. We have 12 months emergency in high yield savings and another 18 months in money market. The rest of the portfolio, spanning in traditional Roth brokerage accounts, consists of an allocation of 85% stocks, 15% bonds. This gives us 3 to 5 years of expenses from my money market and bonds. I took the risk quiz and scored 71. As my portfolio grows, why wouldn't I let the growth continue in my equities and keep the fixed income bond portion at a level to support my 3 to 5 years of expenses, potentially growing to a 90-10 allocation or more over time? How does risk capacity come into play here? Love your show. Interested in what you have to say.
Yeah, this is fascinating, Jason. Absolutely spot on question. You kind of buried the lead, because risk capacity should be at the top, not at the end. Risk capacity really is around how much risk you need to take. I equate it to driving sometimes. You've heard me talk about this. I drive in very early in the morning. I could go, there's people that buzz by me at 80 miles an hour, but I only go 65 because I know I'm going to get from my house to work in the allotted time. It works for me. That's what we kind of believe about money. Why put yourself out there? Why take risk you don't need to take? A 90-10 portfolio anytime in life, I'd say especially in retirement, is fairly aggressive. You need to be prepared to see your money go down by 35% or maybe even 40% if things got really ugly. Are you okay with that? Most people are not, because we've asked many people and very few raised their hand. And it appears you may not if you have a risk quiz of 71. So I would probably do it the other way. I would do the planning work and then decide, oh, I don't need to take that much risk. My risk capacities could be lower, and then build the portfolio. What say you?
Yeah. Risk capacity, that's your financial ability to take risks. So it's like, from a planning perspective and your distribution needs, how much money, as he correctly pointed out, do I need to cover my expenses for, 3 to 5 year period if we go into a recession in retirement? And your risk tolerance is a huge part of it too, though. Or would you be comfortable at a 90-10 in your 80s, for example, and seeing a 35% decline? It's an important question to ask yourself. But I think that the real strategy here is marry the two, right? So you look at, like Tom said, your plan, you see what the minimum level of risk is that you need to take, and then you decide based off of whatever your long-term goals are, whatever your comfort level with risk is, whether you want to be more aggressive or not. And I think the important thing to remember is you might become more aggressive over time because equities grow, but you're also going to start taking distributions off of the portfolio. So rebalancing still should be top priority, and it's a good idea to stay at a consistent allocation over time.
I see very few people that we work with, and again, you can correct me because you work more directly with people than I do, that are in retirement that are 90% in stocks. Not just because they don't want to see their portfolio bounce around, but the other thing you just mentioned about distributions, you need to have a steady base there to start pulling money out in case the stocks go down. Think spring 2020, 2022. We can go back over the years. People are taking money out. Now the market's going down. I got to sell stocks. So in that portfolio that's that aggressive, you may have to sell something after it's gone down. That's not a favorable investment strategy. So that's another reason to sometimes hold more fixed income in retirement. Doesn't necessarily say anything about your risk tolerance, but it says more about your needs for cash.
The other thing is you might have a good idea of what your expenses look like today, but that's also not a guarantee. So even though you have 3 to 5 years of expenses set aside, if you have unforeseen long-term care costs and all of a sudden the market tanks 35% because you're at 90-10, that doesn't put you in a very good position. So you can factor that into your plan and say, what if this happens and I need to spend $100,000 a year on long-term care costs? Will I still be okay?
Yeah, I think that's very well put. Roxy, of course, is one of our, can I say it, rock star advisors here at Pella Wealth. So happy to have her be part of the program. We got time for another question. I guess we can slide one in here.
Yeah.
This looks kind of long, but go ahead.
I just realized every person's name starts with a J
Ooh,
today.
it's the J Show.
Justin,
Okay, Justin.
From Silverdale, Washington.
Beautiful place, sure.
So I will try to give as much information as needed, but if more is needed, please contact me. About 20 years ago, when there was a lot of hype around Robert Kiyosaki.
Robert Kiyosaki. Yes, guy who I've interviewed several times.
And his book, Rich Dad, Poor Dad.
Not a fan of the book, by the way, but we can get into that too. But go ahead.
I read it and told myself real estate would be the way I would get out of the rat race. I just retired from 25 years in the Navy, so I did what I could when I wasn't deployed. I own a rental property in San Diego and in Pensacola,
Florida, yep.
I also own a home here in Silverdale, Washington that my family and I reside in. I bought the rental homes years ago and over the years have refinanced to get my cost as low as I could, 3% range for mortgages. No matter how much I lower cost, insurance increases, property tax increases, and repairs always take any potential profit I may receive as I raise rents.
Okay, wait, that's a good point of inflection. This is something that people have a tendency to overlook because I buy property A, I do a little improvement, I charge all this rent, I make all this money. And what Justin is telling you is it ain't as easy as it sounds, I guess is what I'd put it.
Which is what I see most of the time, by the way, with clients that I talk to, is that I ask them what their net cash flow is, and it's usually not a lot.
Yeah.
So he says, no matter how much, we've already talked about that. So both my properties have been rented by the same families for the last 10 years. I do take care of my properties and my rent increases are reasonable. While I have equity doesn't come in a monthly deposit.
Thank you. That's a very good point, by the way. That's a good point for anything you invest in is how much liquidity is available. Because at the end of the day, and thank you for your service to the Navy, you're going to have your pension. You're going to want some other income, and you got to figure out where that's going to come from. It's not coming from the real estate, then it's got to come from a liquid investment that you could tap into.
I do have TSP and a Roth account with Schwab with VOO, VOOG, and VTWO.
Okay, so VOO is the S&P 500.
Yep.
VOOG, I'm not sure I know what that is.
I actually didn't look that one up, but I think it's a text. I want to say it's tech.
It's the growth component of VOO.
Okay.
So you're owning the same stocks.
And VTWO?
VTWO is the Russell 2000. So you have some smaller there.
Okay. I also have my military pension, so I am not completely real estate for retirement. But I'm wondering if I invested in stocks instead of real estate, would I actually see an increase in my monthly income? I don't think so because capital gains tax seems to be really high, and at least I can write off my rentals to keep my tax base really low. How do people who only invest in the market create monthly income without the high tax base?
You want to take that one first? Because this is interesting.
There's
a lot there.
I think the biggest question to me for Justin is, it sounds like he doesn't need to pull on the equity, or maybe he does. If he just retired and he has his pension, probably some Social Security.
But that's a good point. That would be the starting place to say, what's the number? Yep. Rather than, I just want to have income. Okay, how much income do you want to have in addition to the pension, et cetera?
Yeah. And the other part of it is, so if you do want more liquidity, then you've done a good job building equity in this real estate, but now's the time to liquidate and get it invested so that you can actually use it.
And by the way, he mentioned taxes. I think he's only going to be paying 15%.
Yeah, it's really not that much in taxes. I mean, I understand he's able to write everything off, but he's also not receiving any income. So that's why he's not paying any taxes, right?
Well, he's getting his pension.
Right, but I mean from the real estate.
Correct. So if you're not making anything there, then you don't have a whole lot of
paying taxes.
Correct.
Exactly. So with, one thing that I probably could see him doing is, let's say you sell one of the properties, invest that money. You've got two components to really your total growth. You've got dividends that are either getting reinvested or you're taking those as cash, and then you've also got that capital appreciation. And so the way that people live off investments is they draw a little bit off of their investments, and the goal is to draw a little bit less than what you're earning over time.
Yeah, I mean, and we use a total return philosophy. In other words, we let all this stuff build up. right? The interest, the dividends, the growth. And then we say, well, let's rebalance a little bit, take from the rich, give to the poor, and put some in my pocket. Instead of sort of the approach of turning on dividends, turning on interest, which probably wouldn't make sense for you anyway. So that's how they live off it. That's how it works. And what you just said, the important number here is the fact that in the long haul, if you're invested properly, you should be able to make 6, 7, 8% a year, something like that. I mean, people say 10, but I don't see very many people making that. And then, as you said, you draw out 4 or 5, and I think the numbers work pretty well for long term under that circumstance, right?
Yeah, exactly. So that's really the equation that you're solving for. So how much equity you have will depend on how much income you have, and it also depends on how you invest the money, but you should be able to generate some income if you do want to liquidate those.
I would say, by the way, he didn't give us the numbers for how much is in the TSP or the Roth. You're at an interesting point here, Justin, where you need to start thinking, and you made a good point, Roxy, start thinking about deleveraging your real estate, because if it's not providing a lot of monthly income, and eventually it's going to get harder to take care of it. It's one of those things, you get older, you got to deal with things, and it's more difficult. I would be having a strategy. I have a disciplined approach to say, in 3 years, I'm going to sell this, in 5 years, so that I clean things up. I have more money in my actual pocket to spend as I need it. And you mentioned this in the previous discussion. We never know what's coming along in retirement. You may need additional funds for whatever expense comes along. So I would probably have a practice, a plan, a discipline to sort of reducing my holdings in real estate.
And a little tax strategy, because if you do have this after-tax money from the real estate properties and you have some TSP money and Roth money, you can strategize a little bit and keep your taxes pretty low, I'm going to guess.
Yeah, I think that's great. So great questions today. You please send us more. You go to talkingrealmoney.com, click on Contact Us. We take any type of questions. We take them in order of when they, although one guy just wrote me about a 2,000-word piece on a Social Security website. I can't read it, and I don't know the site. And I mean, I looked at it a little bit; it makes sense. But anyway, unless it's a treatise of some kind, we take the questions as they come. You're staying busy. A lot of people talking to you lately.
Absolutely, people kind of get a little quiet during the summer because I think they're enjoying the sunshine out here. But yeah, a lot of meetings with folks wanting to retire soon, and they just really want some guidance, and that's what we're here for.
Dan, you're doing a great job, Roxy. Thanks for being part of the program. Maybe we'll even do another one of these. I'm heading to your favorite country, France. So you're got to give me the tips. I asked Roxy what I should do with a free day. She said, nothing. I said, I haven't had a day like that since I was about the third grade or something.
Energy guide you.
I see. I don't know. You'll see me wandering the streets of Paris, but I'll try it for a couple hours or something. So thank you for your sage advice there and on all these questions. Questions, please send them to us. If you want some help, again, go to talkingrealmoney.com, click on Contact Us. Let us know what we can do for you. We do offer a free portfolio review, no obligation, no sales pitch, and we'll talk about your plan to make sure you're kind of doing everything you can to pull for yourself. So I want to say thank you very much for listening, for continuing to listen. Our numbers have been fantastic. Thank you for sending your friends. Please send more. And we'll be here basically every single day talking real money.
The opinions and views expressed on this podcast were current on the date recorded.
Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone.
This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction.
Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor.
Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services.
Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit talkingrealmoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.